Tape Reading Concepts. My name is Nikolai, and in this video from the Basic Concept series, I will discuss the most versatile and powerful tool in our charting arsenal, the frequency. The definition: it is a straight line with a moderate slope that projects forward in space on the chart. I presume that most traders employ, or at least have heard of, trend lines. And indeed, frequencies will initially act as barriers to price, just like trend lines. However, at TRC, I teach how to turn the humble straight line with a slope into the cornerstone of a complete methodology for framing price and projecting sentiment to the right. In this video, I'll go over a few of the principles you should employ to improve the quality of the straight slope lines that you chart with. I will use the short position as an example of how I manage my expectation and define the logical exit points and acted on the last one of them almost exclusively with frequencies. The first and most intuitive, arguably most important principle for projecting frequencies forward is slope. For the purpose of visualizing the idea, I will draw a square where both of the diagonals are at a 45-degree angle to the horizontal and vertical axes. A 10-degree slope would be about as much for an upward sloping frequency. My rule of thumb is to look for frequencies with a slope in the range between 10 and less than 45, or about 40 degrees. It all comes down to reliability and thus the predictive value the frequency carries over time. If the slope is 45 degrees or more, such as in this example here with this black dotted frequency, since price will rarely maintain extreme slopes for extended periods of time, the line is quickly going to depreciate as price moves away from it, never to return and work the backside. Therefore, for us as decision takers, this line depreciates in value too rapidly and doesn't carry enough predictive value to be worth drawing or relying on. Alternatively, if the slope is less than about 10 degrees, a horizontal reference point simply does a better job of defining sentiment, especially when you account for the proper level of noise within a market. The next principle is crucial for the reliability of the frequencies you select and base your analysis on. It'll really help you focus your attention to discover and position along important downslopers or upslopers in a timely manner. Recency means that the most useful frequencies will form at or shortly after a crucial turning point in price. Take a look at this sloped ceiling for price that emerged among the initial shoulders on the right side of the first granular significant sharp pivot following the break of major support. The multiple points down the slope clearly show that the offer is relentlessly moving lower. This is the principle of validity. This amount of interaction with the frequency suggests that the sellers anticipate yet lower prices despite the already significant drop. Such strong interest, confirmed by lower prices and on the backside of previous minor support, de facto turns this band into a horizontal level of resistance of high quality. This is what we call a swap zone, and you can see that as price turns over the line and tests the backside of this band, it stops dead in its tracks where the sellers last took the initiative. It is important to note that the break of a frequency does not necessarily diminish its quality. Often a broken frequency will become a swap zone and price will interact with the backside. Such precise interaction further increases the validity of the line as a reference point on the chart. This is the principle of gravity. As price continues its journey downward over time, it tends to revisit important frequencies that formed in the beginning of this progression. Therefore, you can use these frequencies as non-lagging, technically defined exit points, since they wait for you forward on the chart and do not really rely on any math or formulas to plot for you to give you the exit signal. The principle of consistent logic suggests you should draw frequencies aiming to connect pivots of equal value. Let's consider this downward sloping green dotted line. It is created by connecting these two lows, both of which result in $600 counter-directional movements. As such, this downward sloping frequency describes the expected floor for price over time as it continues within its orderly progression downward. So how does it all come together? To the eyes of an experienced chartist, the sentiment of the market comes to life as price dances between logical frequencies and leaves pivots behind. As price respects, breaks, or even dances around certain frequencies, it implies where it is headed next. And once you're able to read the tape, taking entry and exit decisions becomes merely a logical proposition with a risk to reward ratio in mind. To conclude this video, I will take you over the entire story and explain how all these frequencies played a part in my decision-taking process. The context for this Thursday short starts building up all the way back from Wednesday afternoon, where following the FOMC volatility, price leaves behind a beautiful island formation, collapses back down initially to confirmed structural support, in the process breaking strong frequency, and ultimately after a bit of a reaction we do see lower prices, and the attempt to rally also gets rejected for what is a bearish consensus close for the session. Overnight in the Far Eastern session we do find lower lows and some buying interest emerges just above 1760 for a base to build up here. The European traders do take it back up to 1777, leaving us about a $1,700 box within which we are working. I show up around 7 a.m. and here with the US pre-market we see price stabilizing in a coil, and eventually we see a rejection from the highs back towards the middle of the range. This is where this major frequency, our line of maximum excursion, forms, and on the rally attempt price leaves a deficit and then collapses. No buyers found at this structure anymore, and we find lower prices promptly. Because of the convincing break of the last significant horizontal support, I'm looking to get positioned promptly to the downside, expecting significantly lower prices, likely to the tune of doubling this range to the downside. So I'm looking for close to 1700 on this position. I get filled immediately as the pivot gets formed, and I'm taking advantage of the frequency that forms with the initial shoulders to create certain expectations as to what is going to be the slope of this progression. Now, I opted for this aggressive entry first because a reasonable stop could be positioned above this previous support, and also because I have already seen a $400 pullback. Gold habitually makes about a $500 pullback when it has good crisp rhythm, and here on a $600 pullback I assume that this is likely where we're going to see a pivot. It's a relatively aggressive entry, but it is justified by the overall strength and the compellingness of the backside, the protection that the backside of this area, previously support, now resistance, becoming a swap zone. As price starts to pressure here towards new lows, I already have a sloped ceiling, and I managed to establish a sloped floor once price congests in this cluster and gives us the second $600 pullback. Now, the sellers successfully defend their territory here in the mid-50s. As you see that this band becomes a swap area, initially the coil forms as support, we get rejected from here, and now on the way down the sellers take control, turning the mid-50s into a zone of selling pressure. This is where price turns and we had a solid cluster, so it appears that a horizontal barrier emerges. This is a door. If you haven't seen the videos for previously in this series for the door concept or for the island that I mentioned on Wednesday with the FOMC statement, do check them out. The links are in the description below. As price pivots here on another cluster, I can form this sloped ceiling as well, and overall between this ceiling and the sloped floor I have acceptable slope, decent range for this orderly progression lower, within which I anticipate that prices will go likely here somewhere in the low 40s. As we come around back to the door, initially there is a poke, price comes right back above. There's a test and a separation, and this is where I create this frequency in order to see how the reactions from the door are actually going to be perceived by the market over time. I'm drawing this frequency with acceptable slope, and I'm connecting points that are connected, that are created for the same logic, which is reactions from that door. You can see we got this reaction here, this reaction here, and this reaction here. The last two are happening on the right side of the first or the second minor low that is created on the way lower. Ultimately, this door opens and we find support on the back side of my previous slope ceiling, now sloped floor, which suggests that this is an important line towards which price tends to gravitate. Once the new lows are created, again the buyers step in, and this upward sloping frequency defines my expectation within this counter-directional move. Of course, counter-directional moves will happen. Price has to oscillate in its general direction, but what was potentially a warning sign here was that we did get an acceleration once we managed to climb above the door. It would have been ideal if this door was now shut for the buyers and we promptly found lower prices, yet we saw another strong reaction here, similar to what we have seen before. It seems like these buyers really like here you know, the 50s, because you can see that just above this door, the 1750 mark is attracting some good buying interest. We did poke on the sloped ceiling, getting all the way up to this frequency, validating this frequency as a decent reference point for these minor rallies back up. And initially you can see that this poke on the sloped ceiling, which is a downward sloping red dotted line, got rejected and the frequency got refreshed on the right side. You can see that definitely the sellers were looking to take control, projecting another rotation down towards the floor. As price arrived at the door though, we got the same support that we saw previously. And at this point, price is pinched here, and it's the moment of truth for these sellers. Definitely another warning sign here. The buyers did take another initiative between 1750 and pretty much 52, 53. I was interested to see whether this ceiling, along with the last minor structure that was established here, will offer any meaningful resistance. And indeed, as price arrives in this general vicinity here, there is no significantly higher high. The backside of this upsloper now tends to act as resistance. There was no follow through, and we didn't even get all the way up here in the 55s to test this horizontal door, which was now shut for the buyers. Had price actually managed to rally up here, the decisive point would have been the interaction with the major downsloping frequency, or the line of maximum excursion that got created in the beginning of this progression. This frequency had, as we like to say, gone cold because it was not interacted with for a while, and price followed a different logic here within this orderly selling. That being said, the fact that price never got up there is definitely encouraging for my general hypothesis of seeing prices in the lower 40s. You can see that the buyers finally gave up and didn't offer any significant support here at the door. There was no problem to get back below the sloped ceiling that we established earlier within this orderly progression. And what followed here is just a massive acceleration towards the end of the session. Notice the little slowdown, the blip that we experienced at the downward sloping floor. However, with that much momentum, it's very likely we're going to bleed over the edge, and that's why I decided to give this one a chance to go lower. Indeed, there was the pop after this little cluster, and then as soon as I saw the tiny bar, which suggests that we might be running out of sellers. After all, the market was in free fall, and all of a sudden there was enough buying in order to keep within these 189 transactions, to keep prices only within a matter of a few ticks. Definitely the brakes got applied, and I decided to exit with the first strong bullish bar right at my lowest technical reference point, which is the downward sloping gravity line. Notice that while I was initially shooting for a target right around the low 40s here, I never really got to revisit this line here, and since my technically defined target moves lower and lower over time. This is one of the benefits of trading with slope lines or with frequencies. I managed to gain extra few $100 per contract for this position. By that time, it got down here at the end of the session. I hope you found this summary on frequencies and the entire basic concept series helpful. If you're looking to develop your trading skill at professional level, consider joining the mentoring community. Tape reading concepts is a limited size group where you can expect an intensive learning curve. Prior experience could be of benefit, but isn't necessarily mandatory. High level of motivation, however, along with a solid work ethic and a certain commitment of your time are a must. This is serious hands-on education for serious traders only. Thanks for watching. My name is Nikolai at Tape Reading Concepts.